Picture this. You've just closed your 8th consecutive winning trade. Your account balance is sitting at an all-time high, and quitting your day job to trade full-time feels within reach. But while you're mentally calculating your year-end profits, you are entering a period of extreme danger. A hot streak like this is a high-risk psychological volatility event. The invincibility felt during a streak masks a critical vulnerability. As confidence grows, a trader becomes prone to abandoning the very risk management that built the account in the first place. Surviving success means acknowledging a difficult truth. Willpower alone cannot overcome the biological flaws triggered by winning. Biologists call it the winner effect. When you hit a string of successful trades, your brain is flooded with dopamine, altering your neurochemistry. This diagram shows the brain during a winning streak. As dopamine rises, the amygdala, the fear center, shrinks, numbing your perception of risk. This leads directly to risk creep. After 5 wins, you bump your lot size from 0.1 to 0.5, reacting only to dopamine. Real, earned confidence comes from reviewing a journal of over 100 trades. Emotional overconfidence comes from the chemical high of your last 3 wins. When neurochemistry overrides logic, you stop trading your strategy and start trading in emotion. To know if you're actually skilled or just lucky, you need to perform a regime audit. Ask yourself, would my current strategy have worked last month when the market was flat? If Federal Reserve hawkish policy triggers a massive one-way tear in the US dollar, every buy button you hit will look like a genius move. Making money off that massive macroeconomic momentum is known as beta. Alpha is the skill of generating profit in neutral conditions, like precisely rowing a boat instead of being carried by a massive ocean wave. When you mistake beta for alpha, you develop an illusion of control. You begin believing you can predict the next candle with high certainty, which leads to disrespecting your stop losses. The market always shifts from trending to ranging or volatile. Confusing a lucky market regime for personal mastery leaves you vulnerable when the tide turns. Eventually, the streak ends. That first loss sends a physiological shock through your system, causing a sudden, painful crash in your dopamine levels. To get that chemical high back, your brain demands action. You enter a revenge pivot, abandoning rules and sizing up positions to reclaim a lost peak account balance. This chart illustrates the math of ruin. You can win 10 trades in a row, making $100 each. But when overconfidence leads you to 5 times your leverage on an 11th trade, a single move against you erases those 10 wins. Bank for International Settlements data shows retail traders often fail due to erratic leverage spikes during high emotional confidence, rather than a flawed strategy. The revenge trading spiral, triggered when an invincible ego meets a mathematical reality, kills more accounts than the market ever could. Once a winning streak alters your neurochemistry, discipline and willpower are insufficient protection. The modern defense mechanism is the Centaur approach, which pairs human strategic intuition with rigid automated AI rules to act as behavioral circuit breakers. One method is the 3-win rule. After 3 consecutive successful trades, your system automatically locks your lot size to your base level, preventing risk creep. Another circuit breaker is the daily profit cap. The moment you hit a 3% profit for the day, your trading terminal freezes, enforcing a mandatory cooling-off period. Advanced systems now use AI behavioral monitoring. If your data shows you usually hold trades for 4 hours, but you suddenly start closing them in 5 minutes out of anxiety, or holding losers for 2 days out of ego, the AI detects the drift. Implementing automated buffers on platforms like FXNX puts a wall between your dopamine-driven impulses and actual execution, decoupling your ego from your equity curve. The goal of a professional trader is not to maximize a single winning streak, but to use technology to survive the inevitable drawdown that follows success.